Hi, everyone. Welcome to the weekly stock market update. And I've been traveling quite a bit into India to an AI conference, and I'm going to the US next week. So lots to cover, lots to get through. And let me share my screen on that basis straight away. Grab a pen and paper, make sure you're sitting comfortably. You will want to pay attention to this, given what's been happening with the market and given due to travel. I've been focusing just on doing webinars for clients. So the public ones, you've not had one for a while, but here it is, and it's well worth it. As well, you should be able to see and hear me clearly. Do put in the chat box where you are from, so I know whether it's the first time you're on one of my webinars. And I look forward to giving you a heck of a lot of information. We're also going to do some polls. I'm just going to publish one at the moment. You should be able to see that on your screen. So let's get right into it. Now, we've had a 10% drop. This has scared some people. In actual fact, it is the median drop for the S&P. We'll talk about India, China, the UK in this as well. We'll go through Rolls-Royce and a whole bunch of other stocks that are popular with people. Barry, hello from Pinner, Hampshire. We've got Roger, we've got Trevor. Hello, one and all. Welcome, all of you. And as other people get settled in, I thought I'd put some context into this. As you can see, in actual fact, all-timer Theo and Graham, in actual fact, the drop, the 10%, which is what's called a correction, is not unusual. On social media, you'll hear some spotty-faced teenagers calling it a crash. I don't know what their definition of a crash is, but it's not anything that's financially accurate. It has been a fast drop because it's the fifth fastest in history for the S&P. So the number of days that it's taken has put it as the fifth fastest. Took only 20 days, or fifth fastest equal. But it's not unusual, as Tom Jones would say, for the S&P to have dropped. So there we go. 10% drops are the median. They're the average drops that you get in the S&P in any given year. And it's only the fifth fastest. So we've had drops in the recent past, 2018 for one, and 2020, where it's been steeper. So that might provide some context. I always think, as I tell friends of mine, your feelings are not facts. And it seems more so the case with the S&P. Sometimes people feel more than what in reality is happening as well. So here we go. Well, I'm off to Trump land in Florida tomorrow. S&P 500 performance after closing in correction territory. And the 10% drops are regular. Of course, you'll hear people saying crash, end of the world. I'm sure there are some people who've burnt their own homes down before anybody else does it. They've stored up on Andrex. And it amazes me how panic-ridden people get. So the S&P 500 performance after closing in correction territory, usually within a year, it's up. Well, isn't that good news? Now, I'm not going to paint necessarily a bullish picture, but I'm just showing you what the data shows. And I was surprised at this, that after a year post a 10% drop, you're far more likely to be up. Well, 86% of the time, the S&P is likely to be up after a year. In fact, after 6 months, 3/4 of the time, it's already up. After 3 months from entering a correction, the majority of times it's up. Of course, that's no use to the people who've burnt their houses down and buried themselves in a tunnel in a case of ultimate panic, because, of course, the gains they'll miss. They'll still be banging their heads against the wall. So a degree of perspective and facts is always useful rather than chatter, narrative, and feelings. I'm going to mention some of these companies as we go forward. I just came across this from Goldman Sachs. Stocks most loved by hedge funds. Doesn't mean they're necessarily good companies to buy right now, by any means. They could be on a watch list, which is fine. But it was just interesting data. And I will touch upon some of these going forward. It's certainly not me saying go out and buy them. I've two clients in particular who are like green-eyed, jealous girlfriends. And if they see me talking to the public, they absolutely go ballistic. So I just want them to know, the two jealous girlfriend clients, that this is not me saying to people, go out and buy these stocks. What I'm showing them are stocks which are most loved by hedge funds. And it's not even by me. It's in the public domain by Goldman Sachs. So these have been their year-to-date returns, not bang up to date for today. So you can put that to one side. We will go through some of these. To be honest, if all you did was look at these 20 and focus on these, you'd probably do pretty well over the next 10, 20 years. I don't mean buy, hold, and forget, although that might be fine. But I just mean making sure that these were the ones you kept most your eyes on. But we'll, as I said, dive into some of these in a second, in just a moment as well. Kanesh, hello. Martin from Colchester. So just to be absolutely clear, I am not saying today I would buy into these. Actually, today I'm not planning until I see my April data to put my capital into anything. But these are the ones which happen to be the ones which hedge funds are looking at. And we'll come back into hedge funds which are generating 40% per annum. What are they holding and how do they tie in with some of the ones that we've looked at as well, or that we're examining at the moment? Goldman Sachs, as you might know, have lowered their 2025 S&P 500 target. Well, barely by March, from 6,500 to 6,200. So from where we are roughly at the moment, Goldman Sachs still think there's a 10% upside. Now, that hasn't made me rush in to buy the S&P. My clients will already know I exited my S&P 3 times leverage, 2 times, and my index tracker, because since 2023, and this bit most people go deaf at, 2023, we had substantial gains, and I wanted to rebalance, take some profits off that. It isn't a daddy bear, which I'll come to in a second. So that wasn't the principal reason that it looked like it's going to become one. It was the same reason I sold half of Apple last April, only to get back in a bit later at a higher price. So in hindsight, should have just held on to it. It was rebalancing because there were gains since 2023, which had just become outsized. Okay, so currently not in that index or the 3 times leverage or 2 times leverage, which also reduced some of the volatility in the portfolio as well, which was a sensible thing to do. So take some profits, reduce volatility, hold a little bit more cash, which reduces volatility, all seemed very sensible. And it looked like a daddy bear, though premature on that I was somewhat. Okay. Hello, Raheem. Please, can you tell the clients that they are already very rich and we peasants need your advice? I would, but they're like green-eyed, well, there's only 2 of them, like green-eyed jealous girlfriends. They'll be spitting blood right now that I'm speaking to the public at all. NVIDIA, after a 30% drawdown, is this a buying opportunity? Well, let me be absolutely clear what my message is right now, which is right now, I am not looking to buy something as of right now. April, when the data comes out, I may well do so. And it may well be an NVIDIA, but right now it is not. So if, to my 2 jealous clients, don't worry, I'm not giving away the crown jewels. To everybody else, the sensible thing right now, I think, to do is, whilst you will have certain investments you will be keeping an eye on and may well invest in the future, which for me, I continue holding my NVIDIA. That should come as no secret. I'm not looking, there's only 3 things to do: buy, hold, or sell. I'm not looking to buy more. I've not sold. I continue holding what I've got. Despite these falls, I know this is cheap, but I'd rather just wait till I get the April data and things to calm down a little bit more. But that is attractive. Why is that attractive? Well, because at some point I'm going to make a 50% gain in this when it goes back. But for the moment, I'll see if I can squeeze out a bit more to the downside. So I'd rather not have more. These are some of the Russell 1000 stocks with the largest increase in number of hedge fund owners in the 4th quarter of 2024. Just so you know, I do not own any of these as things stand. There may be a time in the future where I want United Health. There may be a time where ServiceNow, Tesla, as my clients know, I got out of a couple of weeks ago. There may be a time in the future where possibly a Salesforce or well, I don't think a Disney, it's just been a disappointment. but those are probably the most likely ones going forward, but not today. So just so you know, action item, not today am I getting into a United Health or a ServiceNow or a Tesla. Tesla I exited 2 weeks ago because of the volatility. I just got fed up with it. I'll come to Tesla in a second. I know people like some of that volatility. I'd rather just not have it in a very volatile market. I'd rather just have a bit of a quieter life. ServiceNow and United Health will at some point in the future, I'm sure, but right now, today, no, thank you very much. But they would be on a future watch list for me. Salesforce, I'm not sure if I've ever owned that, but it's, and I don't at the moment. So I don't own any of these at the moment, but the ones that I've circled, with the exception of Tesla, may well be ones which in the near term are worth looking at. But today, no, you'd probably want to keep your powder dry because these are ones for future gains, but not right now. Part of what we're trying to achieve, see this 10-year annualized return, 15.6% in sterling terms in the S&P 500. Well, if you can get that by just tracking the index, there you go. You just track the index, you got your 15%. Simple, all right? And that'd be fine. If we can eke out a few more percentage points, even better. If you don't think you can, you just track the index, don't you? How have the global equities done? Now, this is February, okay? I just, as I said, come back from India, and I'll come to the India ETF in a second. I'd probably say it's too premature for India. This, at the moment, though probably by the end of the year, might be okay, maybe even in a few months. But it's on my watch list. We're at the time now, end of March, we're a sort of watch list period where things will start getting ready. China does look like it's going to have a good year. The UK is still difficult to call whether it'll be a good year or not. And the others I've really not focused on. But I'm going to drill down into some of these in a second. By the way, I know Rolls-Royce is one that you all ask me about so often. I don't own it. And the simple rule is you've made shed loads of money. And if you're worried about it, look, the simplest strategy to have is not, Alpesh, what does the crystal ball and time machine say? Because I have neither a crystal ball or time machine. It is if it drops X percent, such as 5, 10, 15, 20, 25, you will sell based on your own risk appetite Y percent. Okay? You'll only know in hindsight what Y should be for each X, because hindsight's all you'll have. So what you can go by is your risk appetite. The mistake private investors make is they try to be some kind of perfectionist who can see into the future. Instead, you can just say, look, if it drops 10%, you'll sell 50% of it. Or if it drops 20%, you'll sell 50%. But don't say if it drops 90%, then I'll sell it. So there's going to be some kind of number. I'd probably say I'd get a bit worried if it broke that upward trend. That's there. That's all I've got to say. Now, I could give you some narrative about international defense, industrial spending, what one of my clients told me as a pilot about how in the middle of the air they can get Rolls-Royce calling up the pilot and saying, can you just switch off engine number 3 and restart it, please? We've got some signal issues. And it's like incredible as a service, he said, what they provide. And he's not surprised they're doing so well. I can give you all sorts of those. But actually, quite frankly, if you don't know what to do, base it on your risk appetite and said, if it drops X, sell Y. Okay, what data am I waiting for? Time, the passage of time, Dharmesh. It's the best data there is. S&P 500 bear markets, that should actually say 1929 to 2022. 1 year total return post trough. Now, we've not got a bear market. A bear market means a 20% drop. We've only got a 10% drop. Okay. And actually, they're quite good, those sharp drops. I would quite like a bear market because I know then the subsequent year I'm going to get a bit of a killer return, particularly if I apply a tiny bit of leverage on just even the index, which is what happened in 2023 and 2024 and why a couple of weeks ago I sold out of the S&P 500 because 2023 and 2024 were massive gains after the 2022 drop. So those drops, a bit like what Warren Buffett says, he quite likes bear markets as well and says he finds them very exciting because things get on the cheap and for things which are going to make all-time highs again. And very few things you can say with some certainty are going to make all-time highs. The S&P 500 is one. If it drops 20%, I'm pretty assured, aren't you, it's going to make an all-time high again. And therefore, you just get back into it and maybe add a bit of leverage and you make your crazy returns. It becomes quite easy. The reason private investors can't do it is either they lack the patience, they scare themselves with headlines and call a small correction a crash, and they panic, or they just don't even know what's going on. So yeah, I'd be quite happy if we drop another 10%, because then I'm really am guaranteed it's going to go back to all-time highs and we'll make substantially more. Think about it. If something drops from 100 to 80, i.e. a 20% drop, then it has to go up 25% to get back to its all-time high. If you've got 2 times leverage on that, that's giving you a 50% gain locked in. Simple. Even if it took a year, even if it took 2 years, 50% return in 2 years is pretty good. I'm out of the S&P at the moment. I have got enough exposure to the S&P through individual stocks, which I'll come to in a second. These are the year-end forecasts. Now, I don't particularly care what these banks say in terms of their year-end forecasts. These are the potential upside returns that they see. So be it if they see them. By the way, on the poll on FTSE, will it be higher by 2025? 48% of you think so. Yes. Let's see what you think in terms of the Dow, and for the Dow US markets generally. Okay. On that. So, sorry, Dharmesh, I misunderstood what you meant. Sorry, April data is my data, my spreadsheet. When I pull up my spreadsheet for April, my approved list for April, that's what I'm talking about. When I update my own data, which is just stock prices, valuations, and so on, by that period, that's what I meant. Sorry, I'm going to see if I can pull it up in a second. Okay, now, these analysts all tend to be bullish. We know that from academic research. I've published it in my books. I'll give you a downloadable copy of this, which is one of my 18-odd books, which has been endorsed by hedge fund managers and Bloomberg TV and Traders Magazine and Financial Times columnists as well. So I'll make sure on this call, on this webinar, you get a copy of that. It'll pop up on your downloadables in just a second. But that's pretty bullish, you'd say. I mean, you know, Binky at Deutsche Bank doesn't seem to be getting all panicked, because Binky sees a 24% upside to the S&P from where Oppenheimer's John sees 26%. Vinu Krishna sees 17% to the upside. Manish, not just the Indians who are positive, sees 20% to the upside, and Ed, 24%. So I think they're over optimistic. Probably, I'd rather we did drop a bloody 25% lower. Like I said, it'll lock in 50% to the upside for me. Microsoft, as of 2 weeks ago, I exited as well. Probably a bit late, not permanent, bit late because of the daddy bear scenario, and also I wanted to take some money off the table, and the profits since January 2023, which if you follow me each week, you'll know I've held it since then. So especially on the 2 times leverage, had become substantial. And so it made sense to reduce volatility. It was the daddy bear, and take some money off the table. So that was a couple of weeks ago. My clients will know this. The 2 jealous clients who are watching and saying, why are you telling people this? It's 2 weeks too late for them to know that anyway. So don't worry, don't panic. What's interesting on this one is it's not going to be forever. The return potential is 30% on the basis that if you say from its current price to what the average analyst price target is, you've got 30%. Now, you might as well, wait a minute, Albish, if you do your 2 times leverage on that, that's 60% return you could lock into this. Why are you not in it? Well, I think I can eke out a bit more. I think I might be able to eke out not 60, maybe a 70, 75, maybe even an 80%. Do I think it's got 10% more to drop to the downside? I don't know. Might already have hit its bottom. I just wanted to take some money off the table, stop so much of movements in my portfolio, because since January 2023, it had gone up so much that it was starting to become outsized when you also consider the other holdings that my son and I and my wife had. So, you're more positive on the US markets than you are on the UK ones. I'm giving an investment speech in Florida next week, so I will be sure to show this poll that the British audience were more positive about it as well. Okay. One of the reasons why I'm out of Microsoft for the moment, just so I can eke out a few more gains and rebalance the portfolio, take some profits, and given that I've got so much exposure to the US markets generally. Yet I will be getting in the future. I know that, and will get my 2 times leverage on it and get my 30, 40% return, or hopefully 80% return on it at that 2 times leverage. Well, one of the reasons is this. And you might say, Chetan's been developing their quantum computer. Is this really a big deal? So I was in India speaking to, again, a whole bunch of clever Indians in IT and tech at an AI conference in Mumbai. And they said, yeah, this is the real deal. But it's a bit like 16 kilobit internet connection. We need to get to broadband, and that might take a couple of years. But yeah, this is the real deal. So I said, well, why is it not all over the news? And they said, have you seen how much news is about Trump's stuff? I said, that makes sense. Okay, so this didn't, on a quiet time, this would have made the news. So like I said, I can have two conflicting thoughts at the same time. I can be out of Microsoft knowing I'm going to get in the future. And part of the reason is because of this. Got it? And really, it's a question of, I'm not necessarily timing it as such. I could have just stayed in and ridden the wave. I was rebalancing a portfolio which had got outsized on companies which each week I'd boringly been telling you for the last 2 years, I'm in this, I'm in this, I'm in this. And so I thought Microsoft would be a good victim. As I said, came back from India. This is the exchange traded fund for India. I think it's too early. So again, messaging my two jealous clients, I'm not telling people to buy this, so calm down. Whilst it's bounced off this, and this would be a 25% return if it were to do this. And you could probably put a stop loss somewhere down here if you're really worried it could fall off a cliff, which I don't think it will. I think it's a bit premature. On the weekly side, the short and medium term prices are rising, but the longer term ones might still have a bit more room to go to the downside. So I think I'd rather just wait, just in case it's making a leg up only to drop before it eventually rises. So I think I'd rather wait. But again, on a watch list. Now you might say, well, that's pretty bloody boring. Tell us what to buy now. Well, I can't tell you what to buy now if there isn't something which is sort of ultimately captivating. But there's certainly enough to be watching at as the air comes out of the balloon. And the balloon has let quite a lot of air down. Now, one thing's for absolutely sure. We know it's going to go back up to all-time highs. We can be pretty much assured that that market is going to go. So we know this kind of a gain, which is over a 25% gain, is pretty much assured. It's just that I don't want to get in right now. So if you might want to be premature into it, I don't. Okay, but it will be one which at some point, and keep an eye out on these webinars, I'll try and do another one from the US next week as well. Okay, as well. By the way, I discussed some of the stuff in this. I did it at a TEDx recently as well. Now, if you wanted to be totally over-optimistic, and don't do this, this is from Bloomberg, and it shows the dot-com boom and the current moves. And so the current moves in the market are these, since the start of the bull market, which is from December 2022 till March 2025, till now. And if you take the similar kind of period with the dot-com boom, then you'd be looking at this kind of thing happening. So you could argue, and you know, the people at Bloomberg, I used to do a weekly show on Tuesdays and Wednesdays at Bloomberg TV. They know what they're doing. They're some of the best financial journalists there are. They're not there, you know, to try and get you to be addicted to their headlines. So this isn't done for headlines, but I thought it's interesting. Don't get carried away with this kind of stuff. So where are we in terms of valuations? Well, at the moment, you're paying $26 when you buy a share in Microsoft for every future dollar of profit. It's a bit, imagine Microsoft's a rental property. You're paying $26 to buy the property and only getting $1 in future profits. And you might say, well, is that expensive, isn't it? Well, it's cheaper than what's happening with Apple. It's roughly what you're doing for Amazon, and bloody hell, it's a lot cheaper than Tesla. Makes NVIDIA look cheap, makes JP Morgan, Bank of America, Wells Fargo, Citibank, even Berkshire Hathaway all look rather cheap. But of course, valuation is not the only thing that moves stock prices. If value was the only thing, and this is why when your IFA or wealth manager says, well, these are undervalued companies, you know they're idiots because they're looking at one dimension, which is valuation alone. We also know there are other factors which move stock prices, such as growth. So, which is why JP Morgan has a lower valuation than Microsoft, because Microsoft's expected to grow more, especially with its quantum computing and its AI. Okay. I will come back to Tesla later on, and possibly I think Walmart, Costco, I'll mention a little bit later on as well. And of course, Alphabet, Meta, I'll mention Broadcom, I'll mention as well as we carry on, and Goldman Sachs as well, I'll come to shortly in this. So is it expensive? Is it cheap? Well, actually, that looks ridiculously cheap. I'm not buying any more, just so you know, but that does look cheap. And I was, when I was in India, hoping to hear from some of the entrepreneurs saying, no, NVIDIA's about to get destroyed, or it's you can build this in China, just like you can build an EV in China at a fraction of the cost of a Tesla. They're different vehicles, though. I've been in a BYD and I've been in a Tesla, and they're different vehicles, just as much as I've been in, a Mercedes and I've been in a Ford Escort. They're both cars, but they're different vehicles, if you see what I mean. And the Chinese one feels like it is made on the cheap in China as well. There's a market for all of these at every price point, but don't be mistaken into thinking one is another. And in any event, Tesla's not a car company. If you bought it as a car company, you might as well have bought GM and Ford. It's a patent invention company. Anyway, we'll come to Tesla in a second. Earnings calendar. And by the way, if you don't like volatility, you should have learned the lesson. You don't want to be in Tesla stock. You might as well be in Bitcoin. Earnings calendar, nothing from here is going to move the markets, okay, coming forward. So what about those people who've come along and said, oh my God, Alpesh, I've discovered that stocks can go down as well as up? Well, they might look at exchange trade funds like these. Now, the problem at the moment of even going into a heavily diversified exchange traded fund, which has the entire world economy in, is, for a start, it is overbought, which is what this shows. This shows its short and medium term average prices. And it's a little bit like it was here. This is very much like it was here. And the danger is you are about to get 2 years of sideways moves. I don't think that's actually going to happen. We'll see what happens, but that's the danger. So I'd rather not be in this right now. Okay. I know I do have some of this. I'll tell you where I own some of this. We have a corporate account with Wise, the online money transfer company, and Wise sweep it into a BlackRock World ETF as part of our treasury. So treasury is, you can either keep it in a bank account, you can keep it in a world ETF, or you could put it into Bitcoin. Okay, treasury is where do you put your cash to get a return. I know we have some exposure to this, but what I'm saying is I wouldn't proactively go out and get this at the moment, because my concern is that I'd rather wait for some of the air to come out of this until it sort of bottoms out a bit more, like it did in July of 2023, and then look to get in. So at the moment, not quite for me. But that might change if, all of a sudden this just keeps rocketing, or something happens where peace breaks out in the Middle East, in Europe, and all tariffs are dropped, and the United States joins the Commonwealth and takes over Canada as the 51st state. If all of those things happen, then yeah, I'd probably get into this and take up drugs, because it would seem you'd be in a drug-fueled world for that to have happened. But for the moment, no. And you might say, wait a minute, you keep saying no to everything. Yeah, that's an important message as well. I can't invent companies that don't exist. I can't invent you and give you something to force feed you something, which actually is not a good idea to force feed you. If you want those kind of force feedings of high beta, high volatility stuff, go to Seeking Alpha. They give you all sorts of crap. Wisdom Tree US quality dividend growth. Now that tends to be a lower volatility one as well. But at the moment, no. Look at my concern. That and this. So no. I have to say no. I'm not trying to sell you something. I'm not a stockbroker. I'm not a retail fund manager. I'm not selling you a newsletter and saying, hey, get this. This is the thing. So if you're looking for the headline and somebody to feed you BS, then this is the wrong thing. So at the moment, there'll be a time in the future where this might be appropriate for people who want lower volatility. It's certainly not for me right now, given drops. And it's good that it's dropped, because this will one day go back to all-time highs, but I'll keep an eye on it for you. It might go down to 3. If it goes down to 3, you can certainly lock in a 33% gain at relatively low volatility. But now is not the time. Now is not the time. Let me say that again. Now is not the time. So to my 2 jealous girlfriends, clients, now is not the time. I'm telling people, don't do that at the moment. Similarly with the S&P 500 minimum volatility. Again, the clue's in the title. Minimum vol. What? Alpesh, this is incredible. You can go from 5,000 to 8,000 with minimum volatility. Yeah, but look at that. Very close to looking like this. and 2 years of nothingness. So I'd rather wait until it's closer to something like this period. So at the moment, even the S&P 500 minimum volatility is a wait. But Alpesh, I've got money burning a hole in my pocket. Feel free to wire it over. Leave it outside my doorstep if it's causing you grief. Okay? Give it to the homeless if you've got money burning a hole in your pocket. But putting into this right now, no. Be patient. Wait. Okay? I continue with any individual stocks, continue ticking all these boxes. And here's an important lesson why. Notice how there isn't a column here, which is what is inside Donald Trump's head. In other words, with the stock market, no matter how many boxes you tick, value, growth, income, cash flow, momentum, high average returns, low downside volatility, low volatility generally, 12%, 5%, 9%, you still can't allow for the fact that Donald Trump can do a tweet. And I always used to joke about that in webinars, even when he wasn't president. You can't guarantee the future because Donald Trump might do a tweet. Bloody hell, it's true now. So what are we looking at up to from the start of this year? Okay, well, that's the 0% mark. And in actual fact, a lot of the market is up. Okay, so what's really dragged it down? Actually, a few stocks. These are also the ones which can bubble up very quickly anyway, and we certainly haven't lost faith in them. But actually, there's a lot of stuff which isn't doing too badly. I'd rather be waiting at the moment, but I'll tell you, as you already know, the main things that I got rid of were the NASDAQ, the leverage on NASDAQ, index, ETF, the leverage on S&P and the S&P, and Microsoft. So in actual fact, there hasn't been much change to my overall portfolio at all, in one sense, just a bit more cash, a bit less volatility, because cash is 0% volatility. And there hasn't been a wholesale sell-off in things. And I'll show you why in a second in more detail. So how's the past week been? Well, don't get panicked by a week in either direction, whether it's up or down or whatever. Okay, 27% in a week? What the hell? We're not looking to trade. If you want to trade, I can do a separate video on that, but this is not the trading one at all. Okay, this isn't the trading webinar. So these ups and downs, this doesn't suck me into the market, and the reds don't suck me out of it generally. The past year, pretty good. Microsoft, surprisingly, if you said to me a year ago, you're going to get nothing out of Microsoft, in fact, you're going to have a small loss in it, I would have been shocked. It's all right. I made a killing over 2023 and 2024, and I'm sure in the rest of 2025, whenever we get back in, and next year, we'll make a killing again, particularly in the 2 times leverage of it when it goes back to all-time highs. But at the moment, I'm happy to be out for now because it's a daddy bear. If we get something with a mixture of these over the next 2 years, okay, I'd be pretty happy. There's a lot of positives and greens. Year-to-date performance, not good. Well, actually, it's not good in just these. You've got a lot of stuff, particularly industrials, which are doing fairly well. Some of the consumer defensives, i.e. the things that people need or are addicted to, like Philip Morris and tobacco. Industrials, despite tariffs. Oh, so much for the tariffs then. Wait a minute. I thought it's going to destroy the whole global economy and Donald Trump's ruined the world and it's all on fire. Well, really? Doesn't look it at the moment. No, it's going to happen. Okay, may well do. ETFs, 1 month performance. I will do separate videos on this. My wife, for those who've been following my webinars, presciently bought some gold coins at the end of December, around Christmas time. And that's done well, physical coins. And I think I said in one of my webinars, she's never bought anything to do with investment. And those were the things. We don't keep them at home in case anybody's sort of thinking to pop round. Anyway, year to date, where are we? Well, surprisingly and unusually, the UK is up compared to the other US markets. Well, that's just year to date. Over the past year, that's unusual. The UK is ahead. The NASDAQ, if you looked at this January to December last year, was up 25%. So was the S&P. If the Romans or the Gregorians or whoever the hell it was created calendars from March to March, I wouldn't look so good because I'd only be up 10% on just tracking an index. And it'd be like, oh, you're not so good. 25%, give it 2 months earlier and you looked a lot better. 3 months earlier, looked a lot better. Now you look, that's a bit mediocre. Earlier this month, that was only up 5. But that's how it is. The markets can only ever do one of four things. They can either, like this, go sideways for a prolonged period. That's a 0% return. Look at that, 0% on the NASDAQ. Okay, it's still 10% up. Or they can go down, obviously, or they can go up and then lose all your money. Okay, or they can just go up and up and up. Well, in those four scenarios, only one of them is where it's going up and up and up. 3 times out of 4, it's not making you any money. 75% of the time, it's not making you any money, even if you are getting 15% or 20 or 25%. What happens is, why do people not make money in the markets? Well, because they get bored or they get scared. Those are the two main reasons. They get bored or they get scared. Or they're greedy, bored, and scared. Greedy, bored, and scared. The people who make the most money are probably the lazy ones who wait. Now, S&P 500 correction. What's a correction? 10% drop. What's a bear market? 20% drop. Corrections that did not turn into bear markets, 34 of those. Corrections that became a bear market, 22. Chances are we're sadly not going to have a bear market, which is a shame, because then I could have got into those ones which I'm pretty sure are going to hit all-time highs, like the S&P and so on, and leverage those up and made 40, 50%. So it doesn't look like we're going to get a bear market, unfortunately. It looks like we're in correction territory, and statistically usually doesn't become a bear. But we'll see. Maybe Trump will do us a favor. I'll have a word with him in Florida and say, look, can you do some more really high tariffs and we can get a bear market, please, so that we can ride the upside later on the S&P and on Microsoft in particular. And there'll come a point where I might have to get rid of some of the others, which I'll show you in a second. So where are we on earnings? Well, valuations, 29 times price earnings isn't too bad. Ties in with the average. You're paying $29 for every dollar of future profit. But here's what's interesting. Market cap, the capitalization of those companies, what those US companies are worth, has gone up 11%. Profits have gone up 11%. Earnings and profits mean the same thing. Sales or revenue have gone up 5%. That's not too bad. Market cap has gone up in line with profits. That's pretty good. That's not the case in the UK. Profits are negative. Market cap has gone up. Price to earnings ratios. Now, this is valuations. You want that number to be as low as possible. You want this to be as high as possible. Okay. I don't tend to look top down. I look at individual companies bottom up. You may well know that. Ooh, that was close. You may well know that. So what I do is look at things bottom up. Now, this is where, again, my two jealous girlfriends are about to get really, really antsy. None of these meet my criteria. So jealous girlfriends, none of these meet my criteria. I'm not revealing the crown jewels. None of these meet my criteria. And you can see why, at times like this when markets are falling, why I have to be so stringent. Even then, I'm not guaranteed that what we have will go up every single day. Okay, I've never met a stock which has gone up every single day. So we tend to look at bottom up at stocks, not just, oh, let's get in the healthcare sector because the stories are nice. So we don't do what people think we do. We're very data-driven, not narrative and story-driven, and we're bottom up, not top-down. Top gainers over the past 7 days were these, so be it. Yes, I continue holding Apple, Amazon, Nvidia, Alphabet. That shouldn't come as a secret because I've said it before many times. The UK is a multiple of 18. Like I said, market cap has gone up 3%. In other words, the stock market's gone up that much over this period, and yet profits and sales have been dropping. That is a little bit worrying for the UK. These are the valuations. You want those numbers to be as low as possible. And these are the growth. Well, at least there's lots of growth forecast. People are optimistic. And these are the companies which have done the best. I can't go through all of these at the moment. Rolls-Royce I've already covered for you earlier. What about some of these exchange-traded funds, which might become a bit more popular with people because they realize they're not as brave as they thought they were, and they want less volatility? Well, if you want less volatility, you might want to investigate some of these. They'll give you less volatility generally, and you've got defense, of course, is popping up and doing rather well. You can investigate these in your own time. I've not done a deep dive into these for the moment. Okay. So I want to show you something else. This is a new thing we've been doing for clients. And again, my jealous girlfriends, I haven't revealed anything confidential, so don't worry, relax. We've been putting portfolios together for clients. This is one of our clients, DP. His surname is by coincidence, same as mine, but not related. So this is 28.2% return. So we're not just looking at what looks good now. In other words, what ticks all our boxes now. We then break that down and say, well, I know it's looking good now. How did it do when it, even if you held it previously over the last 10 years, and it during that period didn't necessarily look as good? So given that it looks even better now, i.e. value growth income, it should do better than it's done over the last 10 years. So if we take this as an example of what you see on screen, we then break it down month by month. Now, this is really important because, first of all, the client can then see, okay, 28.2% return. Everybody likes that. But more importantly, are they comfortable with this? That is the same volatility or standard deviation as the S&P. What the hell does that mean, though? I'll explain that in a second. Drawdown means how much your portfolio could drop. So you might have 100,000. You might go as low as 75,000. That's what drawdown means historically. It doesn't mean history will guarantee to repeat itself. It might be worse in the future. Who knows? Okay. But it's to give you an idea of what's happened historically. So you then go to the client and he goes, well, I don't understand what this means though. And we say, right, this is what you want you to do. See this where it says year. And I've only shown since, because the screen resolution, since 2023 January, which is right down there, 2023 January, all the way up to end of February 2025. Okay, so every month. And every stock is there. So you can see how Fortinet is there and Chipotle is there and Visa is there. Okay, so you can see their monthly returns. So this was February of 2025. Okay, you can see that, right? Now, this is really important because what we're actually showing them and what we ask them to do is we say, now go and circle every single red number. So they have to go through manually and say, well, in May of 2024, Fortinet drops 6% in 1 month. Got it? 6% in 1 month. That stock dropped. Yet this is a portfolio which generates 28.2%. So this is to stop them having Andrex moments, okay, where they see a drop in a month and they panic. Then what we do is we say to them, right, now let's look not just at each individual stock this way and what happened in a given month, like it was only down 1.4% there and down 1.1 and so on. Let's now have a look longitudinally all the way down here as well and see that some stocks have multiple months where all they're doing is bloody losing money. Or here, 4 consecutive months of losses. Okay, so this is to get them to realize what 28% per annum looks like annualized over the last decade. All right, and then we break that down and say, okay, and by the way, they got all of the selections came from here, making sure that we pick something with all greens, okay? So something I want to teach you, because now you're ripe for learning because the market's been volatile. We then show them and say, well, let's look at really bad months. Like, I think August 2023 was bad. Why? Well, look, you had one of your stocks had dropped 4%, another had dropped 22%. Fortinet dropped 22% in a month. And that's a portfolio which generates 28%. Another dropped 7, another dropped 7, another dropped 4, another dropped, another dropped, another dropped. So they'd be there saying in August of 2023, Alpesh, half my portfolio's down and I've only been doing this for a month and some of them are down 22%. Oh my God, I want to jump off a cliff. The reason we go through this exercise with them is to say, well, wait a minute. That's within the realms of what's happened historically for a 28% return, 18% volatility. Do you want this? And they might turn around and say, no, I don't want this, too volatile. So we then say, right, let's pick things less volatile. Or they might say, yeah, now I know that can happen, but those are the returns. I'm okay with it. Do you see why that's so important that you've got that analysis? And by the way, if your IFA doesn't do this breakdown by individual stocks, by month, and across the board, that's pretty poor showing if they're not, because it's important to understand that. And we've started doing this for clients so they can understand what is composed in returns. Because actually what they've thought is, as soon as they buy something that, let's say their name is Jeremy, for argument's sake, or Jonathan, they think that there's a column here which says, hey everyone, Jeremy just bought a stock, so this stock is likely to go up now because Jeremy bought it. Well, the market doesn't care whether Jeremy or Jonathan or William bought it. Okay. Now, these numbers are incredibly, incredibly important because guess what happens? They stop fear they control greed, and they increase patience and reduce panic. And it means not just that people think, shall I buy the dip or some stupid things like that? Or, well, you just got to be patient. Hold on, mate. If you buy, well, no, it depends on the quality of the company. What it means is when they found quality companies like a good spouse, they don't let go of her because they say, well, actually, she had a bit of a blowout in August of 2023, but that's okay. It's pretty unusual, happens now and again. But what a sweetie. She's going to make me rich. Okay? Now, don't marry a portfolio, obviously, unless you're weird. But you get the analogy. You get the analogy. So by showing people data, and remember, your feelings are not facts. Facts are facts. And these are facts. Now, this isn't guaranteed into the future, any more than anything's guaranteed in the future. There could be a bright, shining light in the horizon because Putin has just launched a nuclear attack on London any second now. So in case people didn't realize, the past doesn't guarantee the future. Okay. But at least it should be some guide if, given a lot of these were not even undervalued high growth historically, and now we're selecting them when they are, then that gets us a bit closer. And what we're trying to get is that as high as possible and this as low as possible. Obviously, did I state the obvious? Of course I did. Of course I did. Okay. Now, where are we on the S&P? Let's do a bit more on this. Now, it isn't technically a daddy bear. What's a daddy bear? Daddy bear is when this pattern happens, i.e. short and medium term prices are falling. And why is that a problem? Well, it's a problem because this can happen. Okay. And so I got out of that prematurely, Alpesh? Maybe I did. But given that we'd had it for so long in 2 times leverage and 3 times leverage, well, 2 times leverage only since about last November, so I didn't make anything on that. But the 3 times leverage and the 1 times tracker, I thought, you know what? Given that I've also got the other stocks and exposure to the US markets, why not just take a bit more cash, not completely in cash, equally not fully invested like 2023 and so on. And that was it. Do you notice how I used to, many years ago as a young man, I used to fly propeller planes. And with planes, you get turbulence, of course, and you get wind gush. And the trick is you have very small movements. And pilots who are new make massive moves. And the plane doesn't react immediately because that's how aerodynamics works. And so they do it even more, yank it across, and they get impatient. Actually, the established pilot, and there's a lot you can learn from investing and flying, just does a small nudge and then waits. It's just like investing. Small redirection, recalibration, and then you wait. And it's waiting. And Warren Buffett says that, it's about stock market is taking money from the patients, from the impatient to the patient. So that's where we are at the moment. Now, are we about to have a V-shaped recovery, and is that a bottom? I don't know. This might hit and kiss the moving average and then keep going up, but I don't know. So I'm happy to take some money off because that's suitable to my risk appetite. If I go jump in a well, are you going to follow me? You may well do so. You might say, Alpesh just jumped in a well. I'm going to do what Alpesh does. He's a well jumping expert. No, for me, this was suitable given the exposure and the profits and the duration for which it had it and what else was in my portfolio and my appetite for volatility. So I said, no, get out of it. In hindsight, I'm probably wrong because in hindsight, more often than not, you are. Why? For a very simple reason. You can't ever call the bottoms and tops unless you're into witchcraft or you've got a secret time machine. This is the daily chart on it. You'll get some moves up because the daily average prices are moving, but the weekly is still moving lower and the monthly looks like it's moving lower. So I'd probably say we're due for more panic headlines from CNBC any second now. Actually, let me check. It's periodic. It's bound to happen. Oh, yes. Oh, God. I didn't know that was happening. Dow tumbles 600 points and dump stocks on inflation tariff rates. Oh, there we go. 11 minutes ago. Thanks, Pia. Who's Pia Singh? Somebody needs to call up Pia and say, Miss Pia, you're a good journalist, but are you getting the hits you need on your articles? You need to make it even more panicky. So there we are. The Dow is down a bit. Now, NASDAQ's very similar to the S&P. It's not quite a daddy bear at the moment. So was I premature? Maybe. But I did want to take some money off the table and pocket some of the gains. FTSE 100, also a bit overbought. I'm not in it. Should I be? It's not clear enough. You know, when it's like this is what I want to happen again. When it's like this, oversold, down here, and moving upwards. So we get a bit of this stuff, 6,000 to 8,000, 33%. Thank you very much. I'm out of this. Now, could I have and should I have got out here? Yeah, but I didn't. I don't have a time machine. I'll pursue you admitting to your infallibility. Yeah, I like to do that. There's a great movie, Angels with Dirty Faces. Does anybody know it? Do you know how the closing scene goes with Angels with Dirty Faces? If you don't, watch the movie and some of you'll get it and what I'm referring to. It's that. It's so, yep. And anyway, it's clearly a daddy bear at the moment. So will we get back into this in the future? Yeah, we'll get in when this does this, and we will ride it all the way from 1,000 to 2,500 again, or from 1,000 to 2,000 and make 100% in a year or two. It'll happen. Okay, I'm not in this ETF, but I'm doing it because it's a stock market update. Looks like there might be something of a base forming. I'm certainly not in it while that's falling. Now, I know a lot of what I'm saying is I'm not in it. I've never been in Bank of America, but I've always done it as a stock market update just to show you what's happening in banking. And banking is doing okay. It's undervalued, a bit wobbly and volatile. And it's overbought. What else do you want me to tell you? It's a bit like this. What do you want me to tell you? There, don't worry. Everything will be fine. It'll keep going up and you'll keep making money. Well, I'm not your parent. I'll tell you the way it is, which is at the moment, this and this look very similar. I'm not in Bank of America, as you know, I've never have been. Now, the reason I cover Occidental is not because I'm in it, but because Warren Buffett bought a load of it. Did he get in early? It looks like it might have bottomed. I'm not in it. I'm not planning to get into it at the moment, but we'll keep covering it and see. That is the most optimistic upside projection by my team, not by me. I'm not in it. Jealous girlfriend clients who are thinking that I'm giving away the crown jewels, I'm telling people what I'm not in, for goodness sake. JP Morgan, I did also sell out of a couple of weeks ago. Okay. Prematurely, perhaps. Time to rebalance? Well, after that, yeah. Microsoft, as you know, I did because it was a daddy bear. Should I have gone out sooner? Well, I did say, even when it crossed into it, I was holding on and I might regret it because it might drop more. And of course, in hindsight, it did drop more. And so I should have got out sooner, but I didn't. Maybe it's bottomed. I'm not sure. I'm not in it at the moment. I hope now it drops to about there. The more it drops, the more I make when it goes back up to there, which it will inevitably do. Eli Lilly, I'm not in, and I wouldn't want to be in whilst its short and medium-term prices are falling. Goldman's I exited a couple of weeks ago. Why? Well, there was a lot of exposure to the S&P 500. Was it a bit premature? Well, 12 months were up anyway. Did I get out near the bottom? Yeah, let's assume I did, right near there. You fool, you could have waited. Well, this is to show you that I don't have a time machine to get out of the tops and bottoms, but we did well enough to have that, the bulk of the move up. Tesla exited a couple of weeks ago, take out some of the volatility. It was just making the whole portfolio too volatile. Nevertheless, this is still rising, so who knows? But you'd only do this if you really like volatility. Okay. Will it at some point do this and go to all-time highs? Possibly. But most people who like Tesla and are thinking it's going to go up in a straight line must be insane. It may well do that, but it'll do it by giving you one hell of a rodeo ride. Okay. So be careful if you want into it. I could have done with less of the volatility, I'm afraid. Lamb is one for the future, not for now. One for the future, not for now. I want to show you something about the Quality 5, which you'll know what I call my Quality 5, Meta, Microsoft, Apple, Amazon, Alphabet. This is the underwater period. Now, 2022, the reason we have the daddy bear rule is this. We want to avoid the biggest drawdowns. Let me tell you the drawdowns we didn't avoid. We didn't avoid that. We didn't avoid that, or any of these. Okay, we avoided this because of the daddy bear rule. We didn't avoid any of these, just so you know. That meant we were underwater for 8 months in one case. Underwater means negative from entry to exit. Okay. Now, this is important to know. This is the kind of data hedge fund managers give their investors because their investors want to know this stuff. So they're pre-planned. But there's another reason. It's so you can manage the expectations of the investors. And it keeps them calmer and it gets them to keep their money in longer. Okay, which is good for them. It's good for you. The reason I'm showing you this is so it keeps you calmer. I'll share these portfolios. Nothing secret, it's in the public domain. I'm not saying you go out and buy Apple and American Express, but what might surprise people is when they listen on social media that, oh, Warren Buffett sold some of his S&P, sold 0.00004% of his holdings when he sold S&P, is they forget, yeah, he's got 70 billion in Apple. Goldman Sachs has got 20 billion in Apple, and God knows how many billion in all of these other stocks. So they're still heavily invested in the markets. And as you've seen from what I've said about what I've gotten out of and stayed in, now I'm heavily invested. Now, 2024 happened to be attractive because it was from January to December. Wouldn't look so good if it was March to March. Well, I didn't create the calendar, did I? Thank you, Romans. Okay, or whoever the hell creates calendars. Okay, so it was good. And it's given me a nice little cushion for keeping me calm in 2025. I really believe this. We don't have to be smarter than the rest. We just have to be more disciplined than the rest. Disciplined to be patient, because we know movements are in line with historical movements for the kinds of returns we're going for, and disciplined in making sure that, see, if I press that button filtered, that would show you which ones of these out of 10,000 stocks meet our criteria at the moment. And there's about 100 odd that meet it. In terms of pensions, I want to show you this. Generally, certainly over the last 10 years, that's the NASDAQ and that's the UK. And I think that gap's going to get wider. I just do not see anything which makes me think that that gap's going to narrow. Like I said, I'm off to America tomorrow. I'm in the UK today. And I'm going to be speaking to a lot of investors. And I'll let you know if there's anything I see when I'm in the States which makes me think that gap is going to narrow. In other words, I think the American stuff's going to keep growing. And we're going to keep looking at undervalued companies which are growing, generating cash flow with high average returns and low downside. Now, it doesn't guarantee they're going to go up. As you've seen, month to month, 28% per annum can still be a drop. And some years like last year where you get a 40% return makes up for years so far like this year and might average you out closer to a 28, we'll see, or a 25, or a 20, or a 15, whatever it is, the market gives. I can't take, just like God gives and can't force him to give more. What I would say to you is this one. This is from Goldman Sachs Wealth Management. Look at your years to retirement and then decide how much you want in cash, for which read fixed income. Okay, how much you want in equities, and you can always move this tactical range. Now, if you take somebody like me, who my wife says I've got 25 years to retirement, this bit, me moving from there to here, I'm here at the moment. Okay, reducing that tactical by selling Microsoft, S&P, NASDAQ only brought me to down here. That's your tactical range. Okay, that's all I did. Generally, 20 to 40 stocks. Beyond 40. Bit pointless. Exchange traded funds, depending on your age and appetite, they're lower volatility. Maybe 10 ETFs. Okay. Have a look at this for a bunch of free resources. Let me give you the books. Where's the links? Let me give you the book. I've got a bit more coming, so don't worry on this. Make sure you get the book. Make sure you get the book. Where's the book? Where's the book? Where's the book? There it is. Share. Now, hedge funds generating 40% per annum. I don't have a monopoly on knowledge. Which hedge funds are generating 40% per annum? So we looked at some of those, like this one, which has got 4 billion under management. It's generating 53% per annum. We broke it down and said, well, which of theirs tie up with mine? And my holdings, some of the ones I've mentioned already, are actually owned by them as well. It's always nice to see some of the big earners. And why do those kind of big numbers make sense? Well, because if you can get just even 15% per annum, you're doubling your money in 5 years. Is it really worth the effort to try and get 20 because you double it in 3.8? Let's not be greedy. Okay. If we get some good years like last year and it blows the doors off at 40, that pays off. It pays for a couple of 0% years. Okay. And still keeps you almost at this level and you're still doubling. And you're not going to get 2 consecutive 0% years. Because in actual fact, the average positive return is 32% over 2 rolling years on the S&P, and that happens 88.5% of the time. So I'm swimming with the tide, not with the sharks. Yeah, that. Bloody hell. Why do we have the daddy bear rule? Because now and again, this happens, and it just makes sure that we stop getting some really big falls. That's all. We can't have no falls at all. No, let's just avoid some of the bigger ones, okay? Some of the bigger ones, right? And if you get a good year, great. That is what, you know, when you fix the roof, when the sun's shining, you've made your capital. You don't assume it's never going to rain. I don't know if this year will rain. Certainly the analysts don't think so. If you want to see how my approach is, if you haven't got a SIP or an ISA, then you can go to Barclays or Hargreaves Lansdown or Interactive Investors, not an advert for Barclays. It's very easy to open, by the way, okay? And it's tax-free. Just be careful of some of these big name fund managers. The last time the markets were like this, these guys lost 50% of your money and never recovered. They never recovered, okay? So just be careful with these. If you want the data and you want to be part of the program, you'll know the drill by now. I take 10 at a time on these things, and you get a webinar price. And so the new thing, what we're doing, like I said, is we're also creating the model portfolios based on the risk and the appetite that the individual has and the filters. So they're not just selecting off this data and getting my hand holding, but they're actually getting a projection forward to make sure it fits, the volatility fits in with what they want, the returns fit in for what they want. You can go there. I'm going to answer a bunch of questions now. If you want to sign up, we're going to put the prices up. And I always say this, and the reason is because last year was very good in the markets. So it's only fair that we do that. Now, I've got some questions on that. Okay. And that should have given you a pretty good idea of what my, where I am and what my thoughts are. What is a SIP? It's a personal pension in the UK. If you're in the UK, it's a self-invested personal pension. Okay. Is gold too high to buy right now? I don't know, Ray. If you're not sure whether it can go up, and I don't know if it's going to continue going up, it's pretty high at the moment. You shouldn't have more than, say, 5% of your money in gold anyway. Then put a little bit in and wait another month and add a bit more. But I don't know regarding gold. It's not a speciality for me. Should probably ask my wife. But yeah, it's not my. I wrote a column in the Financial Times about gold many years ago, and have a look at the book as well, and you'll see it on that. And what I realized with it is yeah, if you can have 5% in there, and that's probably about it. But I'm not looking to speculate on gold. Okay, I'm not looking to speculate on gold. What I want to try and do is get people. It is a one-off price. Is to get people to understand that they can learn to drive. Okay, and by what I mean learning to drive is when they've got the data and the know-how, and they filter it, create a portfolio, and we analyze the portfolio. We say, right, does that meet your return and risk parameters? And here's the monthly breakdown of how it's done historically. If it repeats that, you get your same returns. Boom, job done. And to protect the downside, we've filtered by value, growth, income, cash flow, and all of those. Question from Naveen. The thing I don't understand is how would the Trump administration, who thrives on uncertainty, change, bluster, etc., then any business in the US markets aren't going to get the stability they're able to plan and grow. So Europe, Middle East, or China ought to be more fertile. Well, I'm a business owner, and do you think I've stopped investing? Nope. Okay. I'm getting buffering. Am I the only one? Sorry about that. What do you think about the Chinese stock market? I think I answered that earlier. I think it should be a good year for China, and look at Chinese ETFs. Would you buy into any of the Quality 5 from April? I don't know. When I do the April presentation and I get the April data, I can let you know in April. One of the mistakes private investors make is they try to make decisions. It's hard enough making decisions on imperfect information, but it's really bad making it before you've got information. So I don't know in April whether I will or not. I will wait. And it might be, and by the way, historically what's happened is, when it's looked a bit like this, it's usually been May or June. It's been more than just 1 month waiting, and it's been fine to wait as well. Okay, people, any other questions on anything that I've mentioned? Let me know. I'm happy to answer. Otherwise, I will leave it at that. Whoops. I'll leave it at that for now. Just looking at the chat box. What else have we got in terms of questions? Is there anything that I've not sure? Oh, by the way, feel free to follow me on on LinkedIn. If you haven't already, let me just show you the link. If you've not already done it on LinkedIn, feel free to follow. Where's my LinkedIn gone? Oh, that's a bit useless, isn't it? There we go, LinkedIn. Do follow me on LinkedIn. If you've not done so already, there I am. And I have articles. So follow, don't connect unless you're a client. I only connect with clients on LinkedIn and their kids who sometimes want experience, job experience, or networks and advice. So please just follow if you wish, because there's lots of resources and all sorts of stuff on there. Anything else? Would you buy? Oh, right. I think that's it. Great. I think I've answered all the questions. Fantastic. If there's any more, you can keep posting them and I'll get them and I'll answer them by email later on. What else did I have to show you? So there's that. If you want to see, there is some free resources here, by the way. If you go to arpitpatel.com/shares, you will see some free resources. You just go down to what you will learn and you will see that's going to become April, March, and February in a second. You'll see, there we go, some useful resources there, all the things which they preview. So arpitpatel.com/shares, and you'll see that there on there. Anything else? No, that's it. Great. Well, that was short and sweet. Sorry it's been so long since I've done a public one, but I've been doing all the private ones twice a week for clients. And to be honest, there wasn't much to do, as you've seen. Was there? Barely had to nudge the portfolio. So the most important thing I'd say to you is don't panic buy right now, and I wouldn't panic sell either. And I'd say watch out for the next one. I'll try and do it from the States next week. In fact, I'll commit to it. I'll do another public one next week. To my 2 jealous girlfriend clients who are really upset that I've spoken to the public, don't be. I'll give you a back rub later. Thank you all very much. I hope you enjoyed that. And I shall speak to you soon. Oh, do have a look at the campaign for 1 million. My campaign to teach 1 million people how to add an extra 1 million through learning to invest into their portfolios. I think that's me done. Thank you all very much.